Linda is 71 years old. She lives alone in a small house in Vermont. She worked her whole life. She paid into Social Security for over 40 years. And every month, like clockwork, her Social Security deposit hits her bank account. She thought that money was hers, free and clear. Then one April morning, she sat down with her tax preparer and he told her something that made her stomach drop. Linda, you owe the state of Vermont over $1,400 in back taxes on your Social Security. She stared at him. She said, "That is impossible. Social Security is not taxed." But it is, and not just by the federal government. 8 states in this country are also taking a cut of your Social Security check right now, and most retirees have absolutely no idea. I am Olivia. I am a senior policy analyst and retirement finance expert. And I made this video for one reason, to make sure what happened to Linda does not happen to you. In the next few minutes, I am going to show you exactly which 8 states are taxing your Social Security benefits in 2026. I am going to break down the specific income thresholds for each state. I am going to explain who is exempt and who is not. And I am going to give you a simple 3-step action plan to protect yourself starting today. But I need you to stay with me all the way to the end because there is a hidden mistake that millions of retirees are making right now. It does not just cost them money on their state taxes. It can actually increase their Medicare premiums for an entire year, and almost nobody talks about it. So please stay with me. This one matters. Let me tell you about Robert. Robert is 67 years old. He retired 2 years ago from a manufacturing company in Minnesota. He did a lot of things right. He waited until his full retirement age to claim Social Security. He set up direct deposit. He even kept a little part-time job at a hardware store to stay busy, just 15 hours a week, nothing major. His Social Security benefit was about $2,200 a month. His part-time job brought in around $800 a month, and he had a small pension from his old employer, paying him another $900. Robert figured he was in good shape. He had always heard that Social Security was not taxed. So when tax season came around, he filed his federal return. He owed a little bit there. He expected that. But then he got a letter from the Minnesota Department of Revenue. The state of Minnesota said he owed over $900 in state income taxes on his Social Security benefits. Robert was confused. He called his brother in Florida. His brother said, "That must be a mistake. I do not pay any state tax on my Social Security." And his brother was right. Florida does not tax Social Security. Florida does not even have a state income tax. But Robert does not live in Florida. Robert lives in Minnesota. And Minnesota is one of 8 states that still taxes Social Security benefits. Robert had no idea. He never checked. Nobody ever told him. And here is the part that really hurt. When Robert's total income crossed a certain threshold, it did not just trigger the state tax bill, it also pushed his income high enough that Medicare looked at his earnings from 2 years prior and charged him a higher premium. That is something called IRMAA, an income-related monthly adjustment amount. Robert ended up paying an extra $70 a month for his Medicare Part B for the entire year. One mistake, no one warned him, and it cost him over $1,700 total. $900 in state taxes plus $840 in extra Medicare premiums. Robert's story is not unusual. It is happening all over this country right now. So let me show you the facts because once you understand this, you can protect yourself. Part 1, the federal baseline. Before we get to the 8 states, you need to understand what happens at the federal level because this is where the confusion starts. According to the Social Security Administration, and this is directly from SSA.gov, you must pay federal income taxes on your Social Security benefits if your combined income exceeds certain thresholds. Now, combined income is a specific formula. It is your adjusted gross income plus any tax-exempt interest plus 1/2 of your Social Security benefits. The IRS adds all of that together. If you are a single filer and your combined income is between $25,000 and $34,000, up to 50% of your Social Security benefits can be taxed. If your combined income is above $34,000, up to 85% can be taxed. If you are married filing jointly, the thresholds are $32,000 and $44,000. And here is what catches so many retirees off guard. These thresholds were set in 1983 and 1993. They have never been adjusted for inflation, not once in over 40 years. So every single year as the cost of living goes up and your Social Security gets a COLA increase, more and more of your benefit becomes taxable. Even though your real purchasing power has not changed at all, for 2026, the COLA was 2.8%. That added roughly $672 to the average retiree's annual benefit. That small bump was enough to push thousands of retirees over the line for the first time. The IRS calls this the Rules in Publication 915. You can download it for free from irs.gov. It has the official worksheets to calculate your exact taxable amount. Now, that is just the federal government. On top of that, if you live in one of these 8 states, your state is also taxing your Social Security with its own separate rules. Part 2, the 8 states. Let me walk you through each one. I'm going to give you the state, the tax rate, and the income threshold where the exemption kicks in, because here is the good news. In most of these states, many retirees actually qualify for a full exemption, but you have to know about it and you have to claim it. Number 1, Colorado. Colorado has a flat state income tax rate of 4.4%. But if you are 65 or older, you can deduct 100% of your federally taxable Social Security benefits from your state income. That means if you are 65 or older in Colorado, you effectively pay 0 state tax on your Social Security. If you are between 55 and 64, you can still deduct your benefits as long as your income stays below $75,000 for a single filer or $95,000 for a married couple. Number 2, Connecticut. Connecticut taxes income at rates between 3% and 6.99%. But if you are a single filer making under $75,000 or a married couple making under $100,000, your Social Security is completely exempt from state tax. And even if you earn above those thresholds, Connecticut caps the taxable amount at no more than 25% of your benefits. Number 3, Minnesota. This is one to pay close attention to. Minnesota has some of the highest state income tax rates in the country. Rates go from 5.35% all the way up to 9.85%. But there is a full exemption if your adjusted gross income is below $84,490 for a single filer or below $118,320 for a married couple filing jointly. There is also a partial exemption for incomes above those levels up to about $120,000 for singles and $144,000 for couples. Above that ceiling, all your federally taxable benefits are subject to state income tax. Number 4, Montana. Montana is the toughest of the 8 states for retirees. It uses the same base thresholds as the federal government. That means if your combined income is above just $25,000 as a single filer or $32,000 for a couple, your Social Security benefits can be taxed by the state. And the only extra break Montana gives seniors 65 and older is a $5,500 subtraction from taxable income. Several other senior deductions have been repealed in recent years. Montana's top tax rate goes up to 6.9%. Number 5, New Mexico. New Mexico is on the opposite end of the spectrum. Social Security is completely exempt from state taxes for single filers earning under $100,000 and joint filers earning under $150,000. Those are some of the most generous thresholds of any state in the country. Most retirees in New Mexico will not owe a dime in state tax on their Social Security. Number 6, Rhode Island. Rhode Island exempts your Social Security from state tax if you have reached your Social Security full retirement age. That is between 66 and 67 depending on your birth year, and your income is below $107,000 for a single filer or $133,750 for a married couple. If you have not yet reached full retirement age or your income exceeds those amounts, your benefits are taxable at state rates between 3.75% and 5.99%. So in Rhode Island, you must meet both conditions. You must be at full retirement age and your income must be below the threshold. Number 7, Utah. Utah has a flat tax rate of 4.85%, and it uses the federal formula to calculate taxable Social Security. But here is the key. Utah offers a tax credit that can wipe out 100% of the state tax on your benefits. If your income is below $54,000 as a single filer or below $90,000 for a married couple, you get the full credit. Above those thresholds, the credit is reduced by 2.5 cents for every dollar over the limit. There is also a separate $450 retirement credit in Utah, but you cannot claim both. You have to choose one or the other. Number 8, Vermont. Vermont has one of the highest top tax rates in the country at 8.75%, but it offers a full exemption on Social Security benefits if your income is $55,000 or less for a single filer or $70,000 or less for a married couple filing jointly. There is a partial exemption for incomes between $55,000 and about $65,000 for singles and between $70,000 and $80,000 for couples. Above those levels, your benefits are fully taxable at state rates. Now, I want to point out something important. This list used to have 9 states. West Virginia was on it, but effective January 1st, 2026, West Virginia fully eliminated its state tax on Social Security benefits after a 3-year phase-out. Kansas, Missouri, and Nebraska stopped taxing Social Security back in 2024, so the trend is moving in the right direction. But if you live in one of these 8 states today, you need to know exactly where you stand. All right, now you know the facts. Let me give you exactly what to do about it. 3 steps, simple, clear. Do these this week. Step 1, log into your My Social Security account at ssa.gov and download your Form SSA 1099. This is your Social Security benefit statement. The Social Security Administration mails it every January, but you can also access it online anytime. This form shows your total benefits received for the year and any federal taxes already withheld. You need this document to accurately file both your federal and state tax returns. If you don't have an online account yet, go to ssa.gov and create one today. It takes about 10 minutes. While you are there, check your voluntary tax withholding status. You have the right to ask Social Security to withhold federal income taxes directly from your monthly payment. You can choose 7%, 10%, 12%, or 22%. This is done through IRS Form W-4V, which you can file with your local Social Security office or manage right there in your online account. Setting up withholding now means you will not get hit with a surprise tax bill next April. Step 2. Check your state's specific exemption rules and make sure you are claiming every deduction and credit you are entitled to. This is where so many retirees lose money, not because they owe taxes, but because they overpay. They do not realize they qualify for an exemption, as I just showed you. Colorado exempts everyone 65 and older. New Mexico exempts anyone under $100,000. Utah offers a credit that can eliminate your entire state tax on Social Security, but these exemptions are generally not automatic. You have to claim them on your state tax return. If you did not claim them in past years, you may be able to file an amended state return to get that money back. Visit your state's Department of Revenue website or check out AARP's State Tax Guide at aarp.org, which provides links to every state's tax agency and explains the rules in plain language. If you need assistance filing, AARP Foundation Tax Aid offers free tax preparation by IRS certified volunteers focusing on people 50 and older with low to moderate incomes. Find a nearby tax aid location on aarp.org. Step 3. Calculate whether your total income is pushing you over a threshold. And watch out for the IRMAA cliff. This is the hidden danger I promised to tell you about and the reason Robert's story got so costly. Your combined income includes your Social Security, pension, 401k withdrawals, required minimum distributions, part-time job income, and even tax-exempt interest from municipal bonds. If that total crosses the federal thresholds, more of your Social Security becomes taxable. If it crosses your state's threshold, you lose your state exemption. And if your modified adjusted gross income from 2 years ago crosses certain Medicare thresholds, you will pay higher Medicare Part B and Part D premiums through IRMAA for the entire following year. The IRS underpayment penalty rate right now is around 6 to 7%, compounded daily. If you owe more than $1,000 at tax time and you did not make estimated payments or set up withholding, the IRS can charge you that penalty plus a failure to pay penalty of 0.5% per month up to 25% of the unpaid amount. But here is a protection many retirees do not know about. If you retired within the past 2 years after turning 62, or if you became disabled and have reasonable cause for underpaying, you can request a penalty waiver using IRS Form 2210. It's right in the instructions. The IRS does offer that protection, so don't panic, but do act. Download Publication 91 from irs.gov, run the worksheet, know your numbers, and if anything changed this year, a COLA increase, a new RMD, a pension adjustment, recalculate because the thresholds did not change, but your income probably did. I want to be honest with you. These rules come directly from SSA.gov, IRS.gov, and AARP. They are official, current as of 2026, and impact millions of retirees. But here's what worries me. These rules can change. West Virginia eliminated its Social Security tax in 2026, and Kansas, Missouri, and Nebraska stopped taxing Social Security in 2024. Income thresholds in many states adjust annually. Legislatures regularly propose changes. Relying only on YouTube notifications to stay informed isn't enough. The algorithm doesn't show you everything, and notifications get lost. By the time you hear about rule changes, it might be too late for that tax year. That's why I created something just for you. In the description below, you'll find a link to join the Global Senior Alerts official WhatsApp channel. When you join, you get a free senior benefits protection guide covering Social Security, pensions, Medicare, banking rules, insurance, and travel regulations, all in simple language. Plus, you'll receive real-time alerts about rule changes affecting your benefits. No algorithms, no guesswork, just straight info to your phone. It's free, takes under a minute, and the link is below. Join the channel, download the guide, and share this video with any retiree you know, especially if they live in Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, or Vermont. They need this info. You worked your whole life for your Social Security benefits. Don't let unknown rules take a single dollar more than they should. I'm Olivia, and I'll see you in the next video.